Hello, and welcome to Understanding Your Economic Engine. This is a series of blogs that I'm going to be explaining how to better get a handle on how your business makes money. Specifically, I'm going to be talking about the damage being done by your use of your cost accounting system to make business decisions. All right. This is the first in a series, as I said. Today we're going to talk about kind of the overarching problem with the cost accounting system and present an alternative. So I'm going to be sharing some stories in these blogs from different clients over the years that'll hopefully connect you with what's going on in your analysis of your economics of your business. And today we're going to do avoiding a financial train wreck. And the story is about a coal mine up in Montana and how cost accounting put blinders on them. All right, so let's get started. Let's talk first about where those blinders come from. In each of us, we have at the base of our brain what is called the reticular activating system. The reticular activating system is a filter, and it basically determines what you're going to experience in your world, and it'll help you notice things or not notice things, what you pay attention to, how you view the world. And so this part of your brain, which determines whether you perceive things or not, is always active and set by your thinking. So your thinking sets the filter. And one of the ways we think about our world is using our cost accounting system and our cost accounting data. And I'm going to be explaining over these next series of blogs how that thinking, how your cost accounting thinking has got blinders on you, just like these mules have blinders on them that keep them from seeing what's really happening around them. All right, so in order to get into this topic, we're going to need to talk a little bit about the cost accounting system and how it works, and basically provide a model that we will then modify and make much simpler and much more powerful. All right. So the box represents your business, and reaching out into the world in which your business sits is your sales funnel. And your sales funnel brings in business, and let's say you sell a product. All right. The money that comes in from that sale comes into your business, and it splits into two parts. And you'll see these on your profit and loss statements or your income statement. The first section below revenue on your P&L is your cost of goods sold, or COGS. And money gets siphoned off from your revenue to pay for the materials and so on that's used to produce that product. And a portion of that in most larger businesses is labor or direct labor dollars. And so cost of goods sold, you can pull up your profit and loss and look on it. You'll have parts and materials. And if you have labor, pay particular attention to what we're going to talk about in this workshop or in this blog. All right, so if you take revenue minus COGS, you'll end up with gross profit. And gross profit is used to pay some variable costs. So your accountants or your controller has no doubt sat down and figured out, so how do we apply variable costs to what we are producing and selling, right? And we allocate costs in a variety of different ways, sometimes on square footage of your factory that's consumed by a process, sometimes by the hours spent on it. No matter what way they do it, it's an allocation, and some portion of the gross profit then gets applied to variable costs, such as energy. Another then section of your gross profit goes to pay your fixed cost. These are your overhead or your burden. And this is your administrative costs, your building costs, your salaried costs, and so on. And then each product also has a little bit of money we pay to Uncle Sam in terms of taxes and, of course, profits. So there's some profit margin associated with each product that we sell, right? And so as the month goes on, and we're going to talk about months here, as a month goes on, sales dollars come in and cost of goods go out, and the gross profits gets divvied up, and you end up accumulating profits. And at the end of the month, a few days later, the accountant, if you're lucky, will come back with what your net profit was for the month. And here's where most folks at some point realize something isn't right here, right? Because there are sometimes months where you make no money. If you made no money, how can we be talking about profits of all those products that you did produce? Right? And so right off the bat, we start kind of questioning this. But most of us, since this is a universal system, we just let it go, right? Okay, so well, there's issues here, but everybody can't be wrong, right? Right. So if you're in a large corporation and you end up in situations where the numbers don't quite add up the way you expect them to, you get into an exercise called variance analysis. And I remember the very first ones I went to back in the 80s when I worked for Alcoa, big aluminum company, or more recently, Cleveland Cliffs, an iron ore company. We sit down in a meeting and all the representatives were there and the financial folks led the meeting and they talk about, well, we had labor dollar variances and hours were shifted here and there and blah, 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 right? Just on and on and on. We had variable costs issues and variances and time delays, and we paid for things earlier, we paid for things later, and just a whole lot of explanations. Fixed costs, how we allocated fixed costs, and there was this variance and that variance and whatnot. And now, if you actually objectively sit back and look at what's going on, you'll realize that it's just a pile of BS. It's just a bunch of bullshit going on, needless complexity that adds no value to the business. I like to think of this as a management committing what I might call managerial muda. If you're a lean person, muda is waste. This is just massive waste. This is complete and total and utter waste of your time. If you find yourself doing this, find ways to get out of it. And this is not how you want to live your life. All right. So, and it's not just a waste of your time. It actually puts the blinders on you. And so we get so wrapped up in the cost accounting view of our world that we completely miss what's going on in our business. And I'm going to explain this coming up shortly in an example from one of my clients back a number of years ago. And in each of these blogs, I'm going to share stories from different clients in the past that'll maybe help these ideas sink in. At any time, though, if you'd like to know how this might apply to your business, at the end of this slideshow, there's going to be my contact information, and you're welcome to reach out and be happy to have a conversation with you to see how these might apply to your business. All right. So what can we do to get away from this? Well, first of all, we're going to simplify this world. First thing we're going to do is in the cost of goods sold, we're going to get rid of that direct labor. That allocation of labor is ridiculous. Take it out of your thinking, remove it, and that's going to change your gross profits. Right? Your gross profits are going to go up because the labor costs haven't come out. And that's going to create a very special version, which we call throughput dollars. And this is all based on concepts developed in the 80s by Dr. Eli Goldratt, which he called the theory of constraints. And he called the special condition of gross profits when the only costs in cost of goods sold were the truly variable costs, the money that left the system. Think of it as pass-through dollars. So throughput dollars turn cost accounting into throughput accounting. And throughput accounting is easy to change your cost accounting books to this format. I'd like you to consider that. And you'll probably want to consider that at the end of this blog. All right. So we're now going to change the world of throughput accounting. We're going to take all that trash, the fixed costs, variable costs, direct labor buckets, take them all and make one big bucket, right? Fundamentally, you've got a bucket of expenses. And if you're truthful, you'll realize that they're fundamentally fixed for any given level of production within some band. Your costs are not variable. Your labor costs are not variable. Your energy costs are not variable. It's just noise, all right? So put them into a single bucket and call them operating expenses. right? And what will happen now is the dollars will come in, your cost of goods sold, that's the money that immediately leaves the system. Now, typically that's material costs, that's contracted labor, such as maybe heat treating or other things that you outsource. Shipping is immediately expense to somebody else. Sales, if you say spend a sales commission, all that's money that immediately leaves the system. It's passed through dollars. So that's what cost of goods sold are. If your COGS only include truly variable expenses, you're setting yourself up nicely to do much cleaner analysis. All right. And so the throughput dollars then flow in and they accumulate and we use them to pay our bills. So when we have got enough money and enough throughput dollars or these special gross profit dollars in to pay all your bills, we say we're at break even. So at some point during your month, hopefully, you have brought in enough throughput dollars or gross profit dollars to pay all your expenses. This is when we're at the break even. We have made no money, right? So the whole notion at this point of profit margins on products is kind of, I don't know, abstract, challenging, interesting, not particularly useful. Profit margins are only figured out after the fact if you had profits, right? So it's not a really useful concept. We'll explore that more in a future blog. But for now, at this point in the month, we have now paid all our bills. Any additional product we sell, the throughput dollars overflow the operating expense bucket, and a little bit trickles off into taxes, and the remainder ends up in our profit bag, right? And that's what we want. Our goal in business is to make profit, right? So this is a much simpler picture. There is one particular thing I want you to notice about our piping here, though, and that is that there is a neck down portion of it. Every single business, doesn't matter what business you're in, you have some point in your process that limits the flow of throughput dollars. And understanding that limit is absolutely critical to your business. So I'll explain this in the context of a coal mine here in a minute, but think about this. The essence of profound insight is simplicity. There is one and only one place in your business that limits the flow of throughput dollars. Now, if you have multiple different product processing lines, there might be 2 or 3, but typically it's 1 per major production process. And understanding what limits that flow is, well, profound, right? And I don't know if any of you are Deming followers back from the 80s and 90s. Deming talked about profound wisdom. I never really understood it until this context. This is profound knowledge when you understand how simple you can make your business. All right. So back in 2005, 2006, I had the opportunity to help a series of coal mines out west. They were in the Powder River Basin. They were doing lean. Lean was hugely popular, still is, but back in 2000 to 2010, 2012, it's pretty much, if you weren't doing lean, you weren't doing consulting work and business improvement. So I was out at this series of mines in Wyoming, helping them do 5S and a little bit of Six Sigma. That's another whole story. But at any rate, there was a mine that didn't need my help up in Montana. And I asked well into my time with them that if I could go visit the sister mine in Montana. And finally I got a permission, and in exchange for a tour, I gave them a lunch and learn, which was about, well, this topic we're talking about today. And it was contrasting cost accounting with throughput accounting. And they had a cost accounting view of the world. And I asked them, so, how much money, what's the profit margin? What's the profit on a train? And this particular mine shipped out about 100 trains, plus or minus, in any given month. And each train, they assured me, made $10,000 in profit. Because I know this model is deeply flawed, I knew that was a deeply flawed assumption. And it led for some very interesting conversations. I had toured and got enough information to understand what work they were doing. And I got to see a really cool Six Sigma project where they were making sure that the train was fully loaded. So each car maximized its number call. Now, this is a good project. I'm not knocking it. It was very well done. It was just off target a little bit. They're also doing a lot of 5S, tackling some of minor labor costs, right? But not necessarily working where it made the most difference, and you'll see why in a second, right? So turns out this mine lost money many months, not most, but many months. They could lose $1 million, they could break even, they could make $1 million or 2 million. That's about it, right? And I explained to them this whole bucket idea, this idea that they're not making any money until they've sold enough trains to pay all the operating expenses, and then all the money from all the subsequent trains, went to profit. And the controller listened to this, and he had a few choice words for me, basically calling BS on what I was explaining. And at the end of the session, he walked out, totally uninterested in the follow-up that we were going to have after a tour of the mine. Several others walked out, except the mine manager. The mine manager, who ran the mining portion of this coal operation, huge operation, said, that's too simple and too damn obvious not to be true. Because what I had basically explained to them, there's some number of trains, and it turns out if they produced, and we verified this later, if they produced 99 trains, they lost $1 million. If they produced 100 trains, they broke even. If they produced 101 trains, profit flowed to the tune of $1 million. And the 102nd train was another $1 million. Now, intuitively, if you think about that, $10,000 a train times 100 trains, that's $1 million, right? And each train after that's another $1 million. That's a completely different mindset. And so this mine manager is listening to this hypothesis that I put out on the table, and he's going, that's too simple and too obvious. And if it's true, oh my gosh, have we ever made a whole slew of mistakes? Now I want you to understand, this is not a new mine. This mine has been in operation for decades. These miners have been in operation for decades. They know their stuff, but they had the blinders on. And this is the worldview of cost accounting, that each train was worth $10,000, was their worldview. So anyway, the mine manager took me on a tour of his pit. It was amazing, the cleanest pit I've ever seen in my life. And we talked about what kept trains from being produced. Because if you think 100 trains over 30 days, that means 3+ trains a day. So either 3 or 4 trains got loaded each day. And what was really important was getting that 4th train each day. And so, just armed with that little bit of insight, started asking, so what creates the problems? And one of the places we went and looked at was the big crusher. And the crusher needed some work, but they couldn't justify it. And why couldn't they justify it? Well, let's look at this. They were doing a lot of interesting work, like that Six Sigma to fill the thing. But because their mindset said each train, the 101st train, is worth $10,000, they couldn't justify the major rework, the millions of dollars that it would take to rebuild the crusher and fix some other equipment or expand certain areas of a plant that would allow them to consistently get that 4th train. All right. So the mindset that a train is worth $10,000 when the reality was the 101st train was worth $1 million is profound. And before we went out of the tour, this mine manager grabbed one of his analysts and said, I want you to plot number of trains shipped and our profitability month by month. And sure enough, it bore out. 98 trains, they lost 2 million. 99 trains, they lost 1 million. 100 trains, they more or less broke even. 101 trains, they made 1 million. And there it is, their own data right in front of me. He's like, oh my gosh, does this ever change everything? How much would you spend to make sure you got your 101st train every freaking month, right? A lot more than if it was only worth $10,000. This was a complete paradigm change and big difference for them. So here's the moral of the story. Every business has a constraint that's limiting them. In this coal mine perspective, that limiting constraint was their brain, the blinders put on them by their cost accounting mindset. And it's blinders that had been in place for decades, all right? As Mark Twain said, it ain't what you don't know that gets you into trouble. It's what you know for sure that ain't so. Thank you, Mark Twain. And that's it for this, this webinar. I can be reached at Rick Phelps at actioncoach.com or phelpsltd.com. We would love to have a chat with you and see how this would apply to your business. All of our initial sessions are always complimentary. So feel free, reach out. Let's have a conversation. Let's remove the blinders from your business. So check out our next blog, which will be covering focus. Thank you.